Of course, the next big milestone after 14K is the all-time high, and that is very reachable next week if stocks don't do an about-face. Let's get right to it with today's closing bell exchange. Tom Porcelli from RBC Capital Markets, Larry Glazer from Mayflower Advisors, Peter Schiff from Euro Pacific Capital, very own Rick Santelli as well. Tom, are you a believer? Are you a believer in 14,000?
You know, it's funny. I know that we love to talk about these things on television. At the end of the day, I don't know what's...
That's why we're here.
Yeah, what's the difference? I don't think that it's necessarily a reflection of an economy that's also gaining momentum. I think that the economy is more moving sideways at this point than anything. I think there are other underlying reasons for the equity market to perform as well as it has, and I think part of that, of course, is central bank policy. But you know, I know it makes for a neat little discussion, but ultimately, I'm more concerned about the economics of this. And the economics of this is we're moving sideways. We're not gaining much momentum.
Right, and that's what we keep seeing, a very choppy situation when it comes to the actual fundamentals.
That's right.
And it's really all about the Federal Reserve, and that's why so much money is moving into the market. I guess the question is, do you think it's sustainable, given the fact that so far fundamentals really have not mattered? What does 2013 look like?
That's the thing. So it's funny. I heard some equity strategist say, S&P 1700, and while fundamentally I'd love to toss that person out the window, practically speaking, I don't think I think why not? Why can't you get there? Because at the end of the day, we're not being driven by fundamentals. I think policy is conducive for the equity and indeed other distortions to be embedded in other markets.
Peter Schiff, if this market is going to take that next leg higher, money's going to have to come from somewhere. You've said in the past you think there's a tremendous bond bubble building. When does it burst, and is that the form of the big money now that comes into the stock market to take it higher?
Yeah. Well, first of all, it's only sustainable, this 14,000, because it is an illusion. It's not real. We're measuring the Dow with inflated paper dollars. When the Dow hit 14,000 back in 2007, gold was $700 an ounce. So measured in terms of real money, the Dow would have to double to get back to where it was in '07. But as far as the bond bubble, it is going to burst. Maybe it's already burst. I don't know. There's a lot of air that has to come out. But imagine what's going to happen to the bond market when all the money that's parked in bonds tries to exit for something real, because people wake up to the inflationary threats that are out there. You don't have the Eurozone crisis anymore. The euro is making new 52-week highs against the dollar, as are many other currencies. So there's a lot of money left to come out. And what if the Fed, I think it's all bluff, but what if the Fed tried to shrink its balance sheet and it tried to sell bonds? The public tries to sell bonds. The government's trying to sell over $1 trillion in treasuries every year on its own. So eventually, when the bottom drops out of the bond market, it's a huge problem. I think in the short run, the Fed's going to print a lot of money to prevent that from happening. And so stocks can keep trending higher, just like the price of everything else. But stocks are going to not go up as fast as the price of gasoline, as the price of food, as the price of a lot of other things that rise when you debase your currency.
So what do you think? You think it continues? You think 2013 means more money into stocks, given the fact that it's the Fed really driving everything?
Well, money is losing value. That's what's happening. And people that recognize that are getting rid of their dollars and they're buying other things. It makes a lot of sense to own stocks than to own treasuries or corporate bonds, for that matter, or any debt instrument denominated in dollars. But I think smarter investors are going to look abroad. Look at what's going on in some of these emerging markets. Look at the Asian markets. Look at precious metals. I think you've got a lull before the storm here in gold. A lot of the Wall Street traders are writing gold off. They're saying the rally is over because there's nothing to worry about. The crisis is over. That's not why gold was going up. Gold was never rising because of a crisis. It was rising because of money printing, inflation, cheap money. If you look at what was going on with gold from 2000 to 2008, gold was doing a lot better before the crisis than it did during the crisis. And the way they papered over the crisis is by printing money, destroying the value of currency. And so gold's going up, and so are stocks.
I have to disagree with the Armageddon forecast here. I mean, first of all, I think milestones absolutely do matter. And if you look, big round numbers play really well on Main Street. When you go to a bakery or a barbershop this weekend, or in between the Super Bowl game, people are going to say, gee, did you see the market? And that gets individual investors re-engaged in the market. And I think that's entirely rational behavior. Look, let's call it for what it is. It's a momentum-driven market. It's driven by fund flows and not necessarily fundamentals. But that doesn't preclude Armageddon necessarily. You've got this worldwide currency issue. There's a lot of scary stuff in the world.
I bet more people are going to be talking about rising gas prices than